Most dividend-paying stocks pay you dividends on a quarterly basis. But real estate investment trusts are a bit different. There are quite a few REITs that pay you on a monthly basis, just as if you were a landlord collecting rent checks month after month. I think that this is a major advantage because even if you don't need the income today, it always helps to get a steady flow of liquidity to keep buying more shares, and on top of that, it also helps you to stay patient when the market is volatile. But what are some of the best monthly paying REITs to buy today? Hey everyone, this is Yoshi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about 3 of my favorite monthly paying REITs. But before I get into it, could you please do me a huge favor and click the like button? That will really help me a lot to produce this content and grow this channel. Thank you so much in advance. So the first monthly paying REIT I want to discuss here is called BSR REIT. Its ticker symbol is HOM.U in Canada and BSRTF in the US. This is a REIT that we have previously discussed on this channel, and its investment thesis is pretty simple. To make it short, this is a REIT that specializes in apartment community investments in rapidly growing Texan markets. It mostly owns assets in Austin, Dallas, and Houston, and all 3 of these Texan markets have performed exceptionally well in recent years, and I expect it to enjoy rapid rent growth over the long run. Moreover, the REIT has a good balance sheet with a roughly 40% LTV, it has a shareholder-friendly management team, but despite that it's very heavily discounted. Its latest share price is about $10.50 per share, but its latest net asset value per share is estimated to be about $19. This means that the shares are priced at a roughly 40% discount to the net asset value, or put differently, the company is priced at 60 cents on the dollar. That's an exceptionally low valuation for a REIT that, from a fundamental perspective, is actually doing quite well. So what's the catch here? Well, over the near term, the company is likely to face some headwinds as new supply hits the market and its interest expense goes up. Most investors only care about the next quarter, they are very short-term oriented, and this is why the market has priced the company at such a low valuation. But if, like me, you can think like a landlord and focus on the next 5 to 10 years, then I think that this is a great investment opportunity. Over time, I expect the share price to recover closer to its net asset value, which could unlock up to 70% upside potential. And while we wait, we earn a roughly 5% dividend yield, which is paid on a monthly basis and helps us to stay patient. And best of all, the company is still able to retain about 40% of its cash flow, which it's then reinvesting into share buybacks, creating value for long-term shareholders. So in my opinion, this is a clear case of short-term pain for long-term gain, and being focused on long-term prospects, I think that this is a great opportunity. Then the second monthly paying REIT that I'm buying is called EPR Realty, ticker symbol ADC. This is one of my favorite net lease REITs, and I have previously highlighted it as the future Realty Income. Both REITs focus on the higher quality segment of the net lease market, but EPR Realty is today far smaller, and this allows it to grow at a faster pace. Moreover, on average, the properties of EPR Realty are a bit safer than those of Realty Income. It has higher exposure to tenants that are investment grade rated, it has more ground leases which are even safer than net leases, and finally its exposure to riskier sectors is also lower. And then on top of that, EPR Realty also has one of the best balance sheets in its sector, which is a major advantage in today's market because it has no debt maturities for many years to come. Finally, its track record is also among the best in its sector, having outperformed Realty Income by a large margin over the past 10 years. But despite all of this, EPR Realty has crashed with the rest of the sector, and as a result, it's today priced at a historically low valuation multiple. Historically, the company has commonly traded at 18 to 25 times FFO, but today you have the chance to buy shares at just 13 times FFO. I think that despite the surge in interest rates, the fair value will be somewhere closer to 16 to 18 times FFO, so there is some upside in here. But I think that the main reason for investing in EPR Realty is its 5% dividend yield, which is paid on a monthly basis, and the company's ability to keep growing at roughly 5% per year on a very consistent basis. 5% dividend yield plus a 5% growth rate gets you to double-digit total returns, and that's very compelling coming from a relatively conservative investment like EPR Realty. And then finally, the third monthly dividend paying REIT that I'm buying is called EPR Properties, ticker symbol EPR. If the dividend yields of BSR and EPR Realty weren't enough for you, perhaps EPR is going to be more interesting to you. Currently, its dividend yield is about 8%, and that's despite having a low payout ratio of 70%. It's paid on a monthly basis, and the REIT has guided to grow its FFO per share by nearly 10% in 2023. So why is it priced at such a high dividend yield? In one word, theaters. About 1/4 of the company's portfolio, as measured by its net asset value, is invested in movie theaters, and the market is very concerned about these assets. The other 75% is invested in other experiential properties like water parks, ski resorts, golf complexes, and those properties are doing really well in the post-COVID world, as increasingly many people want to spend on experiences rather than things. But its movie theaters suffered great pain during the pandemic, and this still impacts the market sentiment of EPR to this day. But there are many reasons why I think that the fears are overblown here. The first thing to consider here is that EPR is not the operator of the theaters, it's the landlord. And not just that, but EPR is a triple net lease landlord, its lease terms are really long at over 10 years, and so its rents are preset for many years to come. Then secondly, the rent coverage ratios of its theaters are today positive. This means that its tenants are able to operate these theaters profitably at the property level. Then thirdly, the rent coverage ratios are expected to keep on improving over the coming quarters following the big successes of Oppenheimer and Barbie. The management team of EPR said on their most recent earnings call that they expect their rent coverage ratios to return to pre-pandemic levels within a year from now. Then fourth, it's important to remember that EPR owns some of the highest quality theaters in the whole nation. I agree that the theater market is likely oversupplied in the US, but that doesn't mean that the higher quality theaters are going anywhere. What it means is that a lot of the lower quality theaters will likely need to close down, but this is actually beneficial for EPR because it will lead to traffic consolidation from the lower quality theaters to the higher quality ones. And then the fifth and final reason why I think that the market is overreacting here is that EPR has already renegotiated its leases with AMC and Regal. It renegotiated the leases in a way that it gave some concessions to its tenants, but in return it got greater safety for the future. Lease terms were extended, and a lot of the individual leases were put into one big master lease, which reduces the risk of future lease defaults. I have written a whole article on why I think that movie theaters are here to stay, and I'll link that article down in the description of this video. But in short here, I think that as new blockbusters like Barbie and Oppenheimers keep getting released, box office numbers will keep on improving, and with that rent coverage ratios will also recover, and the market will slowly warm up again to EPR. Today it's priced at just 8 times FFO, and just recovering back to 12 times, which is still a very reasonable multiple, would unlock 50% upside to shareholders. And while you wait, you earn an 8% dividend yield that's paid on a monthly basis, and the REIT is able to keep on growing thanks to the rent escalations that it has in its leases and new acquisitions that it's doing with its retained cash flow. So these are 3 monthly paying REITs that I'm buying today, but there are actually many others. And if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. And finally, once more, if you could please click the like button, that really helped me a lot. Thank you so much for your support, and see you at my next one. Bye bye.